The purpose of this video is twofold. Firstly, I'm going to demonstrate two different strategies which work on the S&P 500, and secondly, how differently the same market can move depending on what time horizon that we're looking at. I'm going to show you how the S&P 500 is very mean reverting over a few days, and I'm going to show you a strategy which we can use to identify great buying points of short-term pullbacks, but how the S&P 500 is also very trending on a much larger or longer time horizon. And I'll show you a strategy, again, which benefits by buying into some breakouts in the direction of the trend, this time using a weekly chart. So both strategies work, but one buys into short-term weakness and the other buys into longer-term strength or longer-term breakouts. I'll show you the individual strategies, how they work, I'll show you the performance report, and then I'm going to combine them so you can see how they look when they use them together simultaneously. And when used simultaneously, over a period of the last 12 years, they have an equity curve that looks something like this. I'll firstly run through the rules of both the strategies, in case you want to test them out for yourself, and you might even be able to improve them. Now, both strategies are long only. We know that over time, the S&P 500 has just gone up, so it's got a long bias. So by taking long only trades or only buying the S&P 500, we're already putting the odds in our favour. When the market is going down, determined by one of our rules, we simply just won't trade. Okay, strategy number one is on the daily chart, and this is going to be the mean reversion strategy. Daily chart, and trades typically last around 7 to 8 days. Using the second strategy, which is on a weekly chart, we're looking at much longer hold time of around 3 months. So let's just concentrate on the daily chart at the moment. We want to be in a longer term uptrend, and that's determined by looking at the 200 period moving average. So we want to make sure that prices, we use the close, say that is above the 200 period moving average, and then we're allowed to trade. Now, to identify the short-term pullbacks, we're going to use an indicator, and we're going to use Williams %R. Most charting packages use Williams %R, and it's an oscillator. And I'm actually using a 5 period Williams %R, so I've made it slightly faster than the standard. And what we're looking for is when Williams %R crosses below the 20 level. Now, it's 20 on my charts using multi-charts, but some of you might be using TradingView, and Williams %R on TradingView actually goes from 0 being the high to minus 100 being the low. So I've actually got from 0 to 100. So in the lower 20%, minus 20, if you're using TradingView, then your lower 20% will be minus 80. It'll be pretty obvious when you bring up the indicator and check it out. So as soon as we see the close go below the lower 20%, in my case 20, we go long, we buy. And then we hold for a few days and we wait for the Williams %R to go above the 90 level. If you're using Williams %R on TradingView, that's going to be the minus 10 level. And as soon as that happens, we get out of the trade. We're going to have a stop loss in there, and we're going to put the stop loss at the 200 period moving average. I've tried loads of different stop losses with buying pullbacks with the S&P 500, and I found that one works really well. Okay, so that's strategy number one, the mean reversion on the daily chart. Strategy number two is going to be a trend breakout, and we're looking at the weekly chart this time. Now, we want to be looking at the closing prices of the weekly bars, and if the current close is greater than the 100 period moving average on the weekly chart, then we can go long. That's our filter to say yes, we can trade. If it's below, we're in a bear market and we don't want to trade. So if we're trading, we want to be looking, is the latest close the highest close over the last 10 bars? So we look at this week's close and then compare that to the last 9 bars, and if it's the highest one, then that's our signal to buy or go long on the open of the next bar or the next week. It's as easy as that. And the exit, including the stop loss, is going to be at the 100 period moving average of last week. So once you've got your 100 period moving average on the chart, look at what the level was last week, and that's where our stop loss is going to be, and that's where our exit, and it's going to be like a trailing stop loss as well, because it is going to be our take profit. And that's it. So we're buying short-term pullbacks on the daily chart, but we're buying breakouts of new high closes on the weekly chart. So let's go and have a look at what it looks like on the charts. We'll be looking at multi-charts, and I'll show you what sort of results it's produced. I'm going to show you the backtest report using data from Oanda for the SPX CFD, which tracks the S&P 500 very well. And for each trade, I'm going to be buying 10 contracts, which is equivalent to $10 per point of the CFD. Firstly, let's take a look at the daily mean reversion strategy. So daily chart of the SPX 500. This cyan line is our 200 period moving average. You can see we've got no trades when the closing price is less than the 200 moving average. As soon as the price comes above it, we can start taking trades. And down here we've got our Williams %R indicator, and it's a 5 period. And as soon as this crosses below the 20, we buy, and then we exit as soon as it crosses above the 90 level. Okay, so we can see the buy, sell, corresponding to the 20 and the 90 level on the Williams %R. So let's have a look at the strategy performance report. There's the equity curve, which is pretty good, a bit of a wobble around through 2018 and 19, but very strong again recently. Remember, we're just going long only. It made a total of almost $19,000. Again, remember this is the CFD, so the dollar value will be different to that of the E-mini. Look at the total trade analysis. We've got 104 trades, pretty accurate at 75%, average trade 180. And I said earlier, we're average bars in the trade about 7 to 8 days. So that's the daily mean reverting type strategy. Next one, we're going to be looking at the weekly buying breakouts. But before we do that, if you like this type of mechanical strategy, you'll probably like my 22-page Beat the Market strategy guidebook. I include another 3 mechanical strategies or rule-based strategies, a little bit like this. At the moment, I'm giving it away for free, so if you can find the link in the description down below of this video, you can grab that for free right away. So let's have a look at the weekly chart. So now we're on the weekly chart, and the cyan line now is the 100 period moving average, and obviously it's a 100 period on the weekly chart. If I zoom out a little bit, we can see that we're holding trades for much longer. Don't forget these are weekly bars, so this is sort of 2020 here. We've got data right up until the end of 2021, so this is holding here from kind of June 2020 for almost 18 months. Like I said, on average, we're looking at about a 3-month hold. And if I scroll back, you see we're only exiting really when the price goes below the 100 period moving average, and there's a possibility that we're starting to go into a bear market. And then we can enter again when the price comes above it and the close is the highest close over the last 10 bars. We get a little bit chopped up around here when the price is going above and below the moving average, but that's just the characteristics of any trend following strategy. So let's have a look at the performance report. Much less trades, obviously. We've got a huge average trade value, and it's much less profitable. So we've got much less winning trades than we have losing trades, but the winners are much bigger. And we can see that here. Average winning trade of over 3,000. Average losing trade is only 475, with an average win to loss ratio of 6.3. And that's what the equity curve looks like. Again, it's a similar picture to what the daily strategy was, very strong recently. And in this workspace, what I've done is I've combined both the signals. So I know it looks a bit messy on this chart, but if we look at this dotted line here, this represents a winning trade from the weekly strategy. And I've actually got here where the exit is. I've got a weekly sell, so I'm selling 10 contracts from that weekly entry. And let me zoom in slightly so we can see it better. Ignoring the cyan line because we're looking at the daily chart, this is the 200 period moving average. So this is actually irrelevant for the weekly signals. I'm actually taking the weekly signals off of a weekly chart that I've got actually invisible on this chart. So we've got the weekly sell, and then we see we've got a weekly buy again here into another much longer term trade. But then meanwhile, we've got our daily dips, which is the signals from the Williams %R, and then sell the daily rally, which is the exit on the daily strategy. So we've got all these daily in and outs for the daily mean reversion strategy, and we've got the weekly trend following strategy, all on the same chart, all in the same strategy. I've programmed them to combine them. So let's have a look at the performance report. So that's what the equity curve looks like. Here's the close to close, which you've seen at the start of the video, with the green dots representing the new highs. Obviously we're going to be making more money, 26,500 now, because we're combining both the strategies. More trades. It's going to be less profitable because it's sort of averaging out, and the average trade is, again, it's going to be in the middle because it's averaging out. But overall, by combining the two strategies, I think it's quite nice. So we have seen that buying into strength and holding longer term by using that weekly chart strategy works quite well. But if we were buying new shorter term highs, if we were to use that strategy on a shorter time frame like the daily chart or even intraday, it wouldn't work nearly as well, because on the shorter time horizons the S&P 500 is very choppy or very noisy. It's not until we look on a much broader time horizon that prices smooth out and we could take advantage of jumping on the longer term trends. And from that daily strategy that I showed you, we can see that it's better to buy into short-term weakness, almost do the opposite of the longer-term trend following strategy. So they both work, and we can see that combining them could be really quite a nice thing to trade. Now, I know I'm bound to get comments saying, well, why don't you just buy and hold the S&P? It goes up over time, so just buy and hold. And it is a valid point. However, using strategies like I've just demonstrated, number one, you vastly reduce the drawdowns compared to holding over some of those really nasty drawdown periods in the S&P 500. And number two, especially with the daily strategy, which trades much more frequently, is you get to increase your position size after every winning trade. So after every winning trade, your account size will grow, and then you can put on a bigger position on the next trade. And that can really boost profits, especially over a long period of time, over a matter of years, just increasing every single time. We all know how powerful the concept of compounding is. And when you're just buying and holding, you don't get that opportunity. Well, that's given you a couple of ideas for strategies to trade the S&P 500. Do whatever you like with them, modify them, test them, trade them, and let me know if you come up with something better than I've already shown you. Anyway, that's all for this video. If you've enjoyed the video, please give it a thumbs up, and I will see you next week. But until then, this is Jared Goodwin, and thank you.